Welcome back to Morning Trade Live. We're moments away from the opening bell, and we want to give you nice focus here on the big picture. It's our pleasure to welcome in Ann Sonders, Chief Investment Strategist at Charles Schwab. Good morning to you, Ann. Great to see you, as always. I want to do big picture on the market, but I have to ask about Nvidia and the takeaways.
So obviously I don't cover the stock as an analyst, but at least at first blush, it looked like it was, depending on what metric, in line to slightly better than expectations, both on top line growth and bottom line growth. But the initial reaction was a bit negative, and it may just be that kind of backdrop where the expectations bar has gone up so much that you get these sort of knee-jerk, let me take a little profits. It hasn't filtered more broadly into the AI space. Tech is still, I think it's the second best performer now on a year-to-date basis. But, we have to go through these little mini digestion phases if the expectations bar has just gotten set a bit high.
Right. And look, I mean, could have been worse, could have been better. And so many names that would have been tied to Nvidia. Everybody was talking about so goes Nvidia, so goes the market. So luckily, not too dramatic today. In fact, it's down just 0.4% at this moment. In the big picture, yesterday we saw the S&P 500 new high. Friday, we saw the Dow Jones Industrial Average last Friday, new highs. Where do you see markets sort of stepping going forward?
There's been an interesting series of rotations that have been happening under the surface. There is still that mega cap AI cohort that, for the most part, is doing well, and that helps the cap-weighted indexes. But some rotations under the surface. You've seen a resurgence in healthcare over the past couple of months that had been the worst performer in the first 7 months of the year. So an interesting reversal there. On a quarter-to-date basis, you have both small cap indexes that are widely tracked, Russell 2000 and S&P 600, that have about double the performance relative to the overall S&P 500. Within the small cap space, though, interestingly, it's the larger cap names within that universe that are doing well. So even within a small cap area, you still have that larger cap bias. I think the basis for the small cap rally is less pressure on a forward earnings perspective, but clearly also a function of the prospects for Fed rate cuts. Smaller companies tend to borrow a little bit shorter, so all else equal, it's seen to the benefit in the aggregate of smaller caps. So any change in outlook for Fed policy could throw a wrinkle into what has been a pretty meaningful small cap trade in the last couple of months.
Yeah, we've seen rotation. Some of the losers from July managed to come back a bit. GDP comes in 3.3% from the 3%. There were some bright spots within that, and we have PCE tomorrow. Your thoughts on the economy at this moment?
Yeah, so it's old news at this point with the revision to GDP, but certainly it's better to see an upward revision than a downward revision. It looks like the consumption numbers were pretty decent too. We also got the claims data out today, and you saw a move down, not just in initial claims, but a tick lower in continuing claims. And the latter had been a bit of a concern that people were having more difficulty finding jobs. So it's only a 1 week number, but better to see that trend lower. So I think the economy is hanging in there, although we're now in that period within earnings season, the tail end of it, when you're getting reports from retailers, because they tend to have a January end to their fiscal year. So that's why reporting season tends to be longer. And you are getting more information from some of the retailers around tariffs and the impact. And that's where I would argue you're starting to get some troubling news where certain companies are actually putting meat on the bones of tariff impact, the hit they're taking in margins, what their success rate has been, if at all, in passing those higher costs on to consumers.
And it's interesting. I'm glad you brought in the tariff talk. I had one guest who actually said, Ann, that the tariff story has been sort of tucked away, and they were focusing more on AI demand and all things AI and manufacturing revolution going forward. Can we put the tariff story away or not just yet?
Oh, I don't think we can put the tariff story away. And, one of the early debates about tariffs and the impact it would have on the economy, and in particular inflation, was around what type of inflation. Was it more likely to be true rate of change inflation, where it persists over time and multiplies, or that one-time level step up in prices? And I think it's more difficult to lean into that latter argument, a one-time level step up in prices, in part just because of how long the span of time has been and likely will continue to be of fits and starts on tariff policies, announcements, delays, tariff amounts placed in, then they get lowered. In some cases, they get raised. I think tariffs, to some degree, being seen as a bit of a Swiss Army knife in terms of the goals that are there. Is it a revenue raise? Is it about trade deficits? Is it about bringing manufacturing back? So it's the sort of constant changes that in and of itself suggest we're not likely to see this one-time price level reset. What we do know so far is very, very little of the tariff impact is being adjusted by the exporters. Remember, it's the U.S. companies that pay the tariff. It's a tax on U.S. companies. That would be offset if exporters were willing to adjust prices. But in certain pockets, particularly capital goods, exporters have actually been raising prices. So that leaves all of the impact being felt either in corporate profit margins or passed on to the ultimate consumer.
Okay, that was very well said. So not a one-time situation, but more likely persistent, even could multiply. We'll have to wait and see. And that's what the Federal Open Market Committee continues to obviously talk about. And while today I saw we were at 85.3% likelihood of a 25 basis point cut September 18th, there are still some folks who think that Jay Powell could say no rate cut this time. What do you think are the chances, likelihood? What are you watching when it comes to the Fed?
Tell me what next Friday's jobs report for August is, and I would venture a guess of what the Fed is likely to do. PCE is important. It's the Fed's preferred measure. But once you have consumer price index and producer price index, which we do for the most recent month, you can map the components of that into PCE, which is part of the reason why PCE doesn't tend to print well outside the band of consensus expectations. And that band tends to be fairly tight. So it doesn't tend to be a big market mover. So let's assume an inline report. I think the needle will or could move based on the labor market report. And the Fed has suggested this too. Not that they're ignoring the inflation piece, but probably a little bit sharper an eye on the employment side of their mandate. And that could be a needle mover one direction or another for prospects for what the Fed does in September. Another weak report akin to what we saw in July. Not only do I think it cements a cut in September, a really weak report could probably bring that 50 basis point possibility back into market-based assumptions. But we still have more than a week to wait for that.
Well, that's what Scott Bessent was pushing for. I also wanted to talk about the big picture for investors. Rather than being more sector focused, you're more factor focused. And I thank you for reminding us. GARPI, growth at a reasonable price. You're looking at a little bit at that. Tell me more about that story for investors.
Yeah. So, from a baskets perspective, baskets like the meme stocks and retail favorites and non-profitable tech have been kind of power drivers on the upside since the April 8th closing low in the market. But when you look at the factor level, that's where I think there's more interesting shifts, where if you look at a broad set of factors, the value factor has actually done quite well in the last couple of months. Balance sheet strength factors have done well. Momentum as a factor is kind of dropped down. So there is arguably a higher quality spin to the factors that are working, but growth-oriented factors look interesting too. So, forward earnings estimate revisions, positive earnings print. So that's why I throw in that old school GARP kind of term, which isn't generally used. I think the factors at work are kind of a collection of value-oriented factors and growth-oriented factors. I don't think you want to sacrifice one for the other at this stage.
Liz Ann, great to see you. Thank you, Liz Ann Sonders.